Hey everybody, it's Bob with Trade Genius. Got my good friend Phil with me today. Today we're going to talk some more doom. I know you missed us. Stay tuned.
Trade Genius.
Okay, Phil, really interesting confluence right now. I know we're going to touch on the markets a little bit, and the most salient feature, I think, of a recession is the housing market and the trail of tears that it brings along with it. And I'm going to throw it over to you. You have a really good chart here, and then let's talk the markets a little bit. I know we've been kind of quiet for a couple of weeks. It's just been crazy for us guys, and we're going to try to make the podcast a priority again. So, Phil, with that, I will take it to you.
All right, so here is a chart that has basically two lines in it. One line is the unemployment rate, that's the purple line, and that's flipped upside down. And the reason why I did that is so that it kind of made sense visually. The other one is the United States NHB housing market index. So what's the overall housing market doing? As you can see, it's dropped a lot. So it means, there's less sales, there's a lot of price cuts, et cetera, et cetera. And we get these real estate cycles, and on average, we get about an 18-year span between real estate cycle bubbles. And those bubbles always precede a downturn in the economy and typically a recession. And so here we are again. Reason why that's important is because often, it reliably leads unemployment or job losses. And so that's what this purple line represents. It represents when it turns down, people are losing their jobs. It's just the unemployment rate flipped upside down. So we're kind of at that point now where we're going to start seeing a big uptick in the unemployment rate. And really, that's the last shoe to drop in terms of what we're looking for to confirm a recession. I think by now, a lot of people feel like they're already in a recession. We know that the consumer sentiment readings are very, very low. And so just not a very good outlook from most consumers. And we know the consumers tapped out too. We have retail numbers coming out tomorrow. We'll probably have to make a commentary on that because if that also falls off a cliff, then I think it's just, that this is coming. So again, like we've been banging on the drum for many, many months, we're at a point now where we're looking for this economic downturn to start to accelerate. And that's going to lead to lower lows in the markets and things like that. So for now, we're not there yet. The job numbers have been holding up, but what we're saying is this is the next part of where this economy is going to turn down, and we're going to see a number of job losses. And then I think you're going to start seeing that priced into the market more and more. Where I think you're going to start to see that is when we see more bonds being bought and less equities being held. And so we'll start to see, and we're starting to see a shift in the TLT SPX ratio, right? The 20-year bond ratio to the stock market, that ETF is starting to rise against the value of the stock market, something we haven't really seen on a consistent basis for a few years now. And we're starting to see an uptick on that, which typically gives us a red flag that, hey, big money is starting to exit equities and starting to find safety in the bond market.
Yeah, and the only thing I will say is that don't let them fool you with all this inflation talk. They already brought oil down 16+%. I think oil's probably going to be stuck in the 60s range for a while. Look, whenever it gets in the 50s, we've been going along with it, but we've been quick to exit it. And the other thing with the housing thing, this housing downturn is going to be different than all the others, and the reason being is demographics. You have nobody that can buy these homes, and as people start leaving this world and they're leaving it to their kids, these kids can't buy these homes. Look, I already know personally people that had already bailed out of their homes when their parents died. They don't keep the home, they get it right on the market and get whatever they can for it as fast as they can to satisfy the inheritors. And I think you're going to see that accelerated here over the next couple of years. So anybody thinking about investing in real estate, I would advise you no. Anybody thinking inflation is going to stay high, I advise you no. And look, Powell does not want to lower rates because lower rates means stock market goes down. So they're doing everything they can to keep this thing, the ball juggling. And that's our macro view. And I think we'll talk about that. But Phil, let's talk about, last 2 weeks this week and maybe the next 2 or 3 weeks. I think we were right on until the orange man kind of threw a wrench at us here for a week or so. But it looks like we might be tapping out again here. And I think things are going to be really interesting here. Maybe we'll make it to the middle of May, but let's talk about it, and then we'll see about the market rolling over again, maybe in a more substantial and a slower pace.
Yeah, so if we switch over to the SPX chart, we've kind of been climbing back and forth between these levels, and these are just simply large volume nodes or lack of volume inside the profile from last year. So that's kind of where we're currently trapped. Now, I think the problem that we have is that we're at risk for this oversold bounce to roll over. Typically, when we get these large declines, we look for about a 9% rally off of the oversold levels that we had. And we had deeply, deeply oversold readings. Well, we got it in one day. So now what we're doing is we're kind of chopping around up here, reconciling that bounce. I think what's going to happen is we're going to end up getting something along the lines of chop, 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 and then we're going to see a test of these lows. Now, the question remains, are we going to get a new low, or is it just going to just be a matter of, testing maybe a higher low in here? That remains to be seen. One thing I will tell you is that the yearly open is down here. And if we start getting back down here, and we didn't quite tap it on the SPX, but I think they may want to finish the job down there. The other thing too is I'll change this moving average to a 200 on the daily. So that you notice we broke it and then we broke down here, a back test, and we fell. We could potentially see a rally later on to get back up to this level, but this typically caps the price or the price action in the indices when we're in a bear market. You won't see much above that. So even though we may see a rally after this dump is kind of done, we get a rally. This becomes then where you look for that major lower high. If we start to break above this moving average, then you might start talking about testing the previous all-time highs. But until then, this becomes a major lid on the market. And usually in a bear market, you don't really get back above it. The other level that we can look at is the 200 weekly. So we change that to a weekly. Okay. That's another reason why I'm thinking we might not be done down here yet, because a lot of times when you get within striking distance on the SPX, you end up tapping this 200 weekly. Now, we did it on the futures, but we didn't do it on the SPX. And when we came into the 200 daily on the futures, we had bounced initially, and then we came down and hit it on the SPX because SPX levels are a little lower than the futures. So I'm wondering if we don't see a repeat of that where we got it on the futures. Now we need to go get it on the index because the index average is a little bit lower. In any case, we got to be careful here going into next week. After OPEX, there's always that window of weakness. With OPEX is this Friday. We could see this come down and it's going to drag everything down with it, including Bitcoin. Bitcoin might see new lows as well. Who knows? It could possibly even break 70 and you get to tap into that 60s range. I wouldn't be too scared about Bitcoin in the 60s though, because there's so much volume built up in that range from 50 to 60,000, 70,000 from that huge consolidation we had most of last year that you're not going to bust through that on the first go. So I think that would be very desirable levels to catch a knife and go for a bounce. So if we get that, then I think what we're going to see is something along the lines of, let's just say this does come down and then we'll get some sort of move like this. And then that's going to, so you're going to have the A, right? A, and then this will be a B, and then death on the C. So we got this ABC potentially that could, then this C leg comes way down. We could be hitting 4,500, 4,400 and freak everybody out. I'm condensing the time frame here, but this would probably spill out over into, I'm thinking like July potentially.
Yeah. And the other thing I will say, guys, is, when you guys listen to us talk, you don't take it like, oh, I got to do this tomorrow. We're just trying to point out to you, this is directional and we can limp along for maybe 1 or 2 weeks too, and then roll over. But for sure, the market has not cleansed itself yet. And you got to remember, the biggest advocate of a crashing stock market at this point is the orange man. So he desperately needs to get those long dated bonds down so that he can refinance it. Janet Yellen left him a big pile of turds here, $9 trillion in refi. And there's nothing like that out the next 20 years. This was a trap that was set for him. And so he has to manage his way through that. And the only way he's going to be able to scare people into the bond market is to chase them out of the stock market. Now, right now, China's not helping or Japan's not helping. Somebody's dumping treasuries, but they've already made conversations, guys, about the treasury has some tools in their toolkit if the Fed is too slow. But at some point, the Fed has to come aboard and start lowering those rates. And the market follows rates. Remember that. People get confused. Oh, the rates are falling. It's good for the stock market. The market follows rates. They follow rates up and they follow rates down. So look for that. And, the average sell-off is between 39 and 45%, guys, in these environments. And there's a lot of talk out there about the next 12 months, the markets are are green, and that may be true, but we haven't cleansed yet. And I think that's the thing we have to really be careful about here. The orange man fooled us here with the higher reciprocals. People now are just like they have the sell button in their hand, like the easy button, from Best Buy, right, or from Staples, whoever had the button. People have the sell button and ready to go, and people are slowly selling out of this market. So remember, the Mag 7 rolls over, the market can't go up. The Mag 7 controls everything, and they're pretty vulnerable right now, Phil.
Yeah, and I will say this too, like when we start going into a corrective market or a bear market, you have different phases that happen. So right now we're dealing with the shock and then denial. So the shock has been this large downturn, right? One of the biggest drops in terms of points. It's more points than we saw in the whole COVID crash, just to put that into perspective. So, but on a relative percentage basis, not as dramatic in terms of the drawdown in percentage terms. But that's the shock. The next will be denial, because we'll get this, like I said, likely a bounce going into May, and that's going to make it feel like, okay, the worst is over. We'll get this tariff stuff resolved. In reality, you should be looking for an exit if you haven't already. And then the reality check phase comes in. So I won't go beyond that, but those are the first phases of a bear market. So we got the shock, we're going to get the denial, and then you got to brace for reality check when we start cracking new lows later in the year, in a couple months, and everyone just realizes we're not in Kansas anymore. Because remember, everyone is conditioned for this dip to go right back up to the highs, to V reverse. And it could. I'm not going to say it can't. I'm just saying that with all of the metrics now, it's just much less likely than before.
Yeah, you should be looking to exit out. We'll talk later this week about maybe some ideas that you can use to protect yourself even above and beyond, TLT, and that could help you navigate these markets. But you should be getting more and more defensive here the higher the market goes, so that you don't get caught unawares. Because, let's face it, most of the money is older money, and you're not going to have time to recover this thing if you're trading in your 60s and 70s. This could blow your wad here for the rest of your life and permanently change your living standards. So it's okay to make less money to protect your money. So with that, Phil, throw it back to you here.
Yeah, just to wrap this up, this is the TLT SPX ratio. When you get into reset, the reason why we look at this is because normally it's normal operating procedure is to drop against the S&P 500. But where we start going, okay, what's going on, is when we start seeing that drop stop and we start getting these spikes up, and usually it breaks out of a channel. Well, here's our channel that we're in, and we've had a couple of moments where it's gotten elevated, but now we're starting to see a sustained move out of this. And remember, if you look at the volume, the big volume, all through 2024, the banks have been buying TLT. Okay, so it's just, I think they thought they might see something in 2024. Janet Yellen put that off of all that T-bill pumping that she did, which was irresponsible, by the way, and we're gonna have to pay for that now. But now we're starting to see this ratio push up. So if you zoom out, some of the most spectacular pumps in this ratio, okay, came from pre-recessionary moves. So this is very pre-recessionary right here, that we're having a sustained uptick. And basically this is where we are in this move. So potentially that's why we were saying why we're long-term very bullish on TLT, because remember, this is just the ratio. The actual price of TLT easily could go up to, when it's all said and done, $180 or higher. So that move appears to be brewing. This is all the telltale signs that we're heading right into a recession. You've seen again, the housing is basically saying that's all but a given here, and the unemployment rate should start ticking up very, very quickly. Unemployment rates flipped upside down here, so this will drop, meaning that more jobs will be lost. So with that, guys, let us know your thoughts on what we share with you today. And if you need help, like Bob said, navigating these markets, head over to tradegenius.co. We'd love to see you guys in the room with us and take advantage of the volatility that we're seeing. Thanks, Bob. We'll see you guys in the next episode. Take care.
Trade Genius.